subscribe now and press the bell icon. Never miss an update.
Okay, so today we'll just start with chapter 2, and we don't have much time. We'll just straight away start with it. So chapter 2 is about all different kinds of income. So, like, if you pull up the form 1040, then the first section is all about the personal data, which we have already gone through, like the name, SSN, dependents, status, whatever, all those basic stuff. Then directly we come to different kinds of income that will show up in 1040. Okay, that is what they call about different kinds of income, which is gross income. There's going to be some adjustment deductions to that. They call above the line, meaning above the line is above where before the adjusted gross income. So there could be, we'll go through, there is a separate chapter on all these deductions, what can be taken and all. But if you remember, like, there's something called self-employed taxes deduction that will come there, or if there is any insurance deduction, or if any other IRA thing and all. So those are the adjustment that one can make to the income. So income gets reduced by deductions and all. Then we come to AGI. This is a very important term. We don't call it adjusted gross income, but you will see this thing every time we talk about, okay, what is the AGI? Okay, the AGI thing is very important because all the credits, sorry, all the credits and a lot of other benefits are, are directly related to AGI. So, for example, if you're doing like married filing joint returns and the AGI is say above 200,000 level or 400,000 level, then certain more taxes can kick in. Or if it's below certain level, then the person may get more credits. So the AGI term is very important. Then we see what are itemized or standard deduction. We have already gone through it. So standard is going to be a standard amount. As the name says, itemized will depend on different kind of expenses, what is eligible, what is not. And we need to see what is going to be beneficial for the taxpayer. So adjusted AGI gets reduced by these deductions. It also gets reduced by QBI, qualified business income. QBI is only related to S corporations. There is again a separate chapter on that. We are not going to spend too much time on that. All we need to do here is broadly what is the what does it look like? What does the structure look like? Income, there's going to be some adjustment. Then we come to AGI. After AGI, we deduct standard deduction, some other deduction. Then we come to taxable income. Okay, based on this taxable income, the system, the software will pick up the correct tax rate depending upon what bracket you're falling under. And then we derive gross tax liability. After that, let's say the liability is $10,000. After that, the credits will come into the picture. There could be child tax credit, earned income credit, electric vehicle credit, other solar energy credits. There could be different kind of credits. Okay, and these credits, if you see, these credits are deducting the gross liability directly. What are these adjustments doing? They're reducing the gross income. What are the credits doing? They're reducing the liability directly. So the credits are very, very important. Like we definitely want to make sure that the client is getting the best possible credits, because straight away the liability gets reduced. And then we come to net tax liability, or if the withholdings are high, then there could be refund. So let's see this chapter. We're just going to focus on what are the different kind of gross income. But anyways, before we start, you guys must be knowing what all income would come up as taxable. Can anyone give me any example? Anyone, like, I'm not going to take anybody's name. If you know something, just unmute yourself and speak.
Can I try, ma'am?
Yeah, Raksha, go ahead. We'll just start with you.
It could be wages, then income from business and profession.
Okay, stop. If you say everything, what will others say?
Okay, you want me to tell one? Okay.
Yes, only one. Next.
Okay.
Ujjain group, please say one by one, quickly.
Any taxable interest?
Any interest income. Okay, good. Next.
Ma'am, income from salary.
Salary, wages is same, which Raksha has already
Okay.
covered. Anything else?
Ma'am, income from house property.
Okay, rental income. Good.
And
Next.
Dividend bonus.
Bonus is usually it's not a separate item. It's all part of salary for from a US perspective. Anything else? What else will come up as income?
Capital gains.
Yes.
Professional income.
Professional income or business income. And
income from
what?
ma'am, income from other sources like clubbing.
Give me some example of income from other sources.
Ma'am,
8621. Vinita, what are you saying? Huh? 8621. You need to tell about 8621 income. That is income from other sources. 8621 is one of the income. Yes. Okay, so let's go over. Good, like I think we have covered most of them, but let's quickly go over this list. And this list is not exhaustive. Okay, there could be many more items. They're just giving some examples. Section 61, anyways, we don't need to remember. The IRC, they call it IRC, Internal Revenue Code. So whenever we are referring to a section, we say IRC section so and so. Okay, IRC, we need to know what IRC stands for. We need to know what does IRS stands for. So section 61 is talking about all kind of income, compensation for services. This could include fees, commission, benefits, besides obviously wages and basic salary and all. Then business, property, interest, rent, any, yeah, royalties, even that's a form of income. Annuities is like some kind of investment, investment, different schemes where every periodically the person is putting in the money, and annuity is like every year they're getting something back. Okay, it's more of an investment kind of income. Alimony and separate maintenance. So alimony is like as part of divorce or separation, if there is some uh, support or maintenance expense that one spouse has to pay to the another, then they're also considered to be income, but this is only until 2019. After that, if you look into the forms, they have removed alimony and child support and all. Those are not taxable income. If they are not income, they are definitely not even deductible on the tax return of the person who is paying that to the ex-spouse. Then any other income from life insurance and all, pensions, from discharge of indebtedness. If there is a debt that a person has taken and the creditor comes and says, well, you don't need to pay it anymore, then that becomes income, right? They're getting all this money for free, or maybe there's some other consideration involved, but discharge of indebtedness is going to be an income. Any partnership distribution and all, interest in state or trust and all. Income in respect of a decedent, that means like the person who has died. So the income which he or she has earned, but it was received after the death. Okay, so there are a lot of those incomes. Now we need to go over the main ones, and we'll see what forms are issued for what kind of income. Because those are the forms, those are the terms that you need to be aware of, since we will be using them quite a lot when we do the 1040 returns. Now, Form W2. Who knows what is Form W2? Muskan? Right. And what is Form 1099?
It's for interest and dividend.
Yes, it could be interest, dividend, it could be a lot of other things as well. 1099 means any other, lot of other income are covered with 1099. When you say 1099 INT, that specifically is for interest, INT, interest. 1099 div, that's for dividends. 1099 miscellaneous, it could be for any other category, besides interest and dividends and all. Okay, so now we'll go over the source of income. Well, rental income is also needs to be reported on 1099. Now, like recently, you guys have issued 1099, so you must be knowing that we are reporting any proceeds given to a attorney. Okay, that needs to be reported as a 1099. There is specifically one block for any payments given to to a lawyer or something, like attorney or lawyer, they would put it there. Or it's just unemployment, sorry, just that, what is that, Tanya? Unemployment compensation, huh? The box one for 1099. Where do we put the contractor payments?
NEC.
NEC. No, but what is box one called? Rohit should be able to tell us. He just recently worked. Even today you were working on 1099s. Right, Rohit? I'm talking about Rohit or Jen.
Yes, ma'am. Ma'am, box number 1.
Yes. Okay, you can open it up later and you can tell. We'll just continue. So anyways, those are non-employee compensation, NEC. Either we can have a 1099 MISC or there's some new form that has been just issued like 2 years back and they call it 1099 NEC, non-employee compensation. So if an employee gets some compensation, obviously it will go on W2. If a non-employee gets it, it could be a contractor, it could be a consultant, it could be an advisor, it could be just somebody coming and helping out and with some of the task at the office or at business, and then that will go in 1099 NEC. So now we'll see domestic versus foreign source income, which income is taxable where, and how do we determine? So if a person is residing in India, getting a W2 from US, then W2 clearly tells this is US income or somebody from US is paying, right? An Indian company will not issue a W2, but the person is performing services in India. So how do we make sure which country we should be, reporting that income as the taxable income and which other country should be taking tax credit? So which country has a first right on taxes and other country would have to claim the tax credits? A lot of rules around it. Salary, wages, usually the very standard thumb rule that we can go with is if we have to see where the services are performed. If the person is sitting in India and doing the work in India, the source is India. So that India has the first right to tax on that income because that is an earned income. All the efforts have been provided when the person is a resident of India. So salary, wages, other compensation, we have to see where services were performed. We cannot just say, oh yeah, this is W2 issued by US, okay, take that as US income, and something issued by India, Form 16 or whatever, take that as India income. No, it's quite possible the other way around, that the person is living in US, but he still got some Form 16 or some other income from India. So how do we do that then? In that case, we'll have to see maybe US has first right. Where services were performed, that is very important. Again, business income, personal services and all, we need to see where services was performed. So a lot of people staying in India, they're running a LLC, S corporations and all, where business is being done in US, but technically speaking, if really income tax department wants to come and check, then it may not be the right stand, that they should not be saying that as US income unless they can prove that there is a team in US and because of their efforts the revenues have been generated. And Tanya, I think you know whom I'm hinting towards. Maybe Raksha, you should also know.
Yeah, I remember. I know one client. Yeah.
Yes. So then there is interest income, dividends, rent. Rent is like usually coming from a property. So we have to see the location of property. Okay, dividends, which company is paying? It's a US company paying or foreign company paying? That country will have the first right to tax it. Interest, residence of payer, not the recipient. Who is paying it? Okay. So again, royalties and all, we have to, if there's a natural resources, you have some patent, copyrights, then we have to see where property is used, or there's a mining or some other thing, then we have to see where the where is the tangible location of that property. Okay, then any real property, and also this table will help us understand when we don't know, when the person is like deriving income from one country, staying in another country, how do we make sure which country has the right to tax first. And a lot of times, if we look into our client's tax return, we lot of times we see W2 is coming from US, but they are residing in India, so we do not take that as US income. We always we we will we will add a W2, we will put everything over there in US 1040, but we will also mark that as foreign income and will report to IRS that way, that W2, although W2 has been issued, but this is still a foreign income. And in India, we will put that as domestic income. That even though it is from foreign sources, but India has first right. Okay, this is a bit confusing, but yeah, go ahead.
Nitika, this all happened Corona time में people who came India and stuck here, na?
Even now we are doing it for a lot of clients.
But that time,
It was very
very
it was very common because people got stuck for like 6 months, a year, and all, and then they were. So that was the year of 2020 was like a big confusing year for a lot of people, because it's not like they wanted to work from India, but they just got stuck, or they got stuck in US or some other country. So that's why I think there was some relief also given, Raksha, for those year, that particular year, or maybe the following year, that mm, that like, as especially from US side, that if you are staying for more than 6 months in particular place and all, and if you're not able to travel because of the restrictions, then those, like, there is a relief given. Like, so the people, those who stuck in US, they don't have to report that as US income, even though they were physically residing in US. Okay, because that was a unusual situation where there were some restrictions placed and all those things. So there's some kind of relief given, but again, there is a window for that. It's not like you can keep staying for a year or two and then you say, "Oh, I'm stuck." Okay. Again, there are some more things like pension distributions. Now, pension doesn't come up like when you are providing the services or when you are an employee. It will be paid later on, right? When the person is retired. So this is again very, very important. And one of the things which they have not included here is, and which is very important for our kind of clients, are the RSUs, stock options or stock income. RSUs are restricted stock units. A lot of companies, especially US company like Amazon or Google or Microsoft and all, they also pay stocks to, they also like give stocks to their employees as part of the compensation. And the stocks are not given right away. Stocks are granted. There's a proper plan for that. There's a proper mechanism. It's not like you're working for the company and very first day they say, "Oh yeah, please come and take 5,000 stocks or 100 stocks or whatever." Stocks are granted when they finish off, like, say 3 to 4 or 5 years of service. Then those stocks get vested. That means that is when the employee can actually get those stocks. Okay, and that's when the company will also put that up as a taxable compensation. So by that time, now 4 to 5 years is a big, like, good amount of time. What if the person has moved across the countries? So for year 2018, let's say the person was in US, got some stocks, but the stocks really got vested in year 2022. And in 2018 he was in US. 2020 he moved to India. 2022 the stock compensation income came from US, saying that, okay, because you finished off so many years of service, so we will give you these stocks. Now who has a right to tax here? Honey, can you tell who would have the right to tax? Which country would have right to tax on that stock income? Once again, the stock income is given for the period of 2018 when the person was a US resident. It was granted to them. Given meaning not like they got real stock, but it was granted. The right was given to them. that if so and so conditions are met, they will get it. In between, after 2 years, they moved to India. But in 2022, when 4 years were over, they got those stocks. Yes. So the right answer is the place where services were performed. Right? So every year the stocks are granted. It's not like one-time thing. So then we have to see when the person is selling the stock. That's why it's very important. Whenever you see those RSUs or supplemental information in 1099, or you see those stock options being sold off, we always have to ask them, okay, which lot does it come from? When did you get those stocks? Which year is it from? At what price were they granted to you? What was the market price that time? When it got vested, what is the market price? Now, when you're selling it, what is the price? So it's not like if they're having 5,000 stocks and if you're sold off 500 stock, we take any 500 stock and we do our calculation. No, no, no. We have to go specifically with the lot. They call it lot. So is it from 2017 lot, 2018 lot, which year lot it belongs to? It belongs from, and where the person was at that point of time. Okay, what year was that given for? Okay, so those all facts will help us understand yeah, where should we put that up as taxable income. So, and again, California is very aggressive that way. That's why California state keeps sending notices. For a lot of our clients keep getting those notices, especially for the stock option sale. They would have left California like 10 years back. Okay, but they're just holding the stock. Let's say they work for Microsoft in California or Cisco, some like year 2010. And then year 2011 they came to India. Now they're still residing in India, and it's 2022. For the last 10 years they've been residing in India. Now if they want to sell those stocks, California will not let them go off the hook. California has that information. It's very aggressive state. So if you don't file it in California, even though it's 10 years, everything is like finished off with California. They've never filed a return. They don't have any property. They don't have anything to do with California. Still, the moment W-2 is issued to them, or moment like some 1090 something is issued to them saying that they received the stock, the state also gets the information and they'll immediately send out a notice that these stocks were given to you when you were a California resident. So why are you not filing returns and paying off your California taxes? So some of the states are very, very aggressive. Texas doesn't care. Texas doesn't even have state tax and all. And I mean, it's also, you can say that they have a very robust, tech, which can actually find out which taxpayer is getting what income. So that's easy because this is the reason why I'm saying this, because this is very, very common. In fact, the people, those who have moved out of California, they were not even green card holders or US citizen. They're all like become non-resident completely for US purpose. For last 5-7 years, they must not even have filed the returns for 10 years. Why? Because they're not required to. And we got so many of those kind of cases that like then the notice have come to them and they came to us saying that, okay, I have nothing to do with, I don't know why suddenly they're sending the notice. And we had to ask them like, you must have done something. They will not suddenly send the notice. They received some information from somewhere. So maybe you sold off the stock or maybe something was issued to you. And then they come and then tell, oh yeah, I probably sold off this thing. I don't even remember. Okay, so they have not included this thing here. We should I'll put up another line item. The stock options, it will go over here only, wherever the services were performed. What time is that? Okay, 6:12. Okay, so now let's go into math, and there is another full chapter on stock options, and also will not get too much into it right now. The reason why I spend more time on it, because this is very common to our clients. We cannot ignore the stock option thing or stocks thing. We have to understand how it works, because every other client of ours would have this kind of complexity. Now, method of accounting, we can go with cash method, we can go with accrual method. IRS has given us this, flexibility, and that's why again, whenever we are doing business returns, especially business returns, with individuals, there's not much choice. You just have to. Mostly, it is going to be on cash basis. There could be an exception. So, I mean, we'll see what, when the accrual method will come into the picture. But for individuals, mostly on cash basis, because individuals are not required to have a huge accounting system with them or keep so much detail of money coming in, going out, and all those things. But businesses have a responsibility to do that. Businesses are supposed to maintain good, solid accounting system, very thorough and clean, because they are running a business. So IRS would expect them to have proper records in place, and that's not the expectation from individuals, because their income is from limited sources and all, and otherwise, and they don't even want to put that burden on individuals. Otherwise, like, people will focus on earning money, or they'll just get buried under these heaps of papers and put all these information and all those things. So that's not really required for individuals. But again, method of accounting is very important for businesses. So every time you do an ATX return for a business, you have to first understand, when you open a prior year return, we need to first see, whether this return was prepared on cash basis or accrual basis. And then we are going to start with our current year return. And this has happened. There's a reason, again, this is very practical problem. This has happened with many times in the past. The entire return were prepared. Everything was done. The file was reviewed. In fact, we just wanted to finalize it, and then we realized, we made a mistake. It was probably not looked into it thoroughly, and also prior years were done on cash basis, but this time, we didn't even see, because QuickBooks will just, there is some default system. QuickBooks will give you the P&L on default basis of accrual. And if you don't pay attention whether this is accrual or cash, you may use the wrong numbers and all, and then it becomes a problem. Every client, is no such thing that the client would have, the businesses have to follow accrual method. They can definitely go with cash method also. And that's quite in contradictory with the practices in India. Is that right, Raksha? I think
Yes,
in India, whether it's a small business, medium-sized business, they just have to go with accrual method.
accrual basis. Yes.
Yeah. So, and then there's something called hybrid method. There's another third kind of method which IRS allows, saying that, okay, you can, few accounting treatment, you can go with accrual basis, and few treatment on cash basis, but you have to be consistent every year. We cannot keep changing that. Hybrid method is not that common, but it's allowed. And what is accrual method? Like, whenever the right to receive has been fixed, or the amount can be determined with reasonable accuracy. So, if the services are performed, and there is the full right has been established that now they can receive the money, we can book that as an income, even though the money has actually not come in and it is sitting in accounts receivable. But the taxes have to be paid on that money. And the same way for expenses. If the services have been performed by our vendors, we can take that as an expense, even though actually we have not paid them for their services. So that's accrual method. We'll just go over that. And this later we'll just go over that. First, we'll just finish up constructive receipt. Now, what is that? Constructive receipt, meaning, obviously, as the name says, it is not the cash receipt. Okay, the money is not hit the bank account. So when you take your December 31st statements, you'll probably not see the deposit there, but constructively it has been received by the taxpayer. That means it is in the control of the taxpayer. It's just not reflecting in bank. Just because it is not reflecting, and we cannot tell on cash basis that, oh, no, I haven't received it, we are not going to report it. Technically, if we strictly go with the rules, even though we have received the check in hand, but it is not yet deposited, IRS wants you to report that as income. That's different. What business do in practical sense, that's different, that they will probably not show, or they'll say, oh yeah, I never received it, or I didn't know about it, and all those things. But that's okay. But what the rule, if we need to know the real rule, it has to be reported. Now the percentage of audit is very, very small for businesses. So that's why, like, I mean, people can actually play around with it. So income not actually in taxpayer possession is constructively received in the taxable year during which it is credited to his or her account, set apart for him, or otherwise made available so that he or she may draw it upon any time. So in a way, it is given to them, or it has been kept aside, or the rights have been given. It's just that it is not reflecting in the bank. But if all the other conditions are satisfied, we may have to report that as income, even though the books are done on cash basis. Like, for example, a check received in the mail is considered to be income on the date received. So if the check comes on December 28th, technically we should be putting that as a taxable income for that year. But maybe the taxpayer is on vacation that time, and he doesn't even get to know that it has come in until January 5th, when he comes back, and then probably he'll deposit, and then they'll say that, oh no, this will come up as the income for next year. But if IRS audits and they find out, no, the check was mailed out on 22nd, so by 25th or 26th, it has definitely landed in in the mailbox of the recipient. If they can prove it, then they may want the taxpayer to consider that as the previous year's income, and there could be interest and penalties and all other fines and all that they can put on it for not reflecting the income properly. Okay, so this is one of the example. Second example, if the person is doing security trades and all, usually we'll have to go with the trade date, like when was it actually bought and sold, the stocks, not on the settlement date. Settlement date could be 3 days, 2 or 3 days after, or maybe once in a week they'll do the settlement and all, especially if the person is a frequent trader, is buying, selling every day and all. So we don't have to wait until the settlement date. Because the trade has been done, it's over, it's complete, it's finished. It's just that the settlement is happening after a few days. So we'll have to go with the trade date. So income is, and again, it depends on facts of the cases. We have to understand, we have to make our own professional judgment. We need to be reasonable there. IRS cannot put all the rules here, or all different situations, that if this happens, then you go with that. If the other situation happens, then you take a call on this thing. They, at the end, they may cover a few situations. In the end, they say that you as a professional or as a business owner need to take your own decision whether you're doing is right or wrong. Use like the commonsensical approach, reasonableness approach, or just judge your own situation and see. Because if IRS starts auditing, the onus is on the taxpayer to prove that they have put it up correctly. IRS doesn't have to prove anything. So it's we who need to prove to IRS that no, this is how we have prepared our account, and we have properly reported all our income and all our expenses. And on what basis? We need to prove that this is the basis we took. This is the assumptions that we made. This is the professional judgment we had called upon, and based on all the reasonableness of the situation, we have come up to this decision. As long as we can prove this is reasonable, this is a regular business practice, it's like the taxpayer has been consistently doing that, and no action is taken only because for the reason of evading taxes. If we can just prove that there is no willful intention to defraud IRS, then it's fine. Then they'll accept it. Okay, it applies to the cash method of accounting. Obviously, constructive receipt, we don't even have this kind of concept in accrual, because accrual is very simple and clear. If the services are performed, issue the invoice. Even if you don't issue the invoice, even it's not even that they will go with the date of the invoice. Because again, issuing invoice is in your hands. You can, December invoice, you can very well push it to January or February and say, hey, I don't have any income for December. So that date is also not like, it's not really important when they start auditing. They will see when were the services performed. So maybe some email from client saying that, okay, this work has been done. Or maybe if you're putting consultants at client place that, okay, how many hours the consultant worked there, what has been done. So again, those records are all need to be maintained by taxpayer. Date of invoice doesn't matter. This is all in our hand. We can manipulate it the way we want to. IRS is not going to look into that. You can put any date you want to. Okay. Claim of right doctrine. So if a taxpayer receiving payments under a claim of right and without restrictions, then we have to include that payment as income in the year received. 1 minute. A taxpayer receiving payment under a claim of right and without restriction on its use or disposition include the payment and income in the year received, even though the right to retain the, okay, what they're trying to say here is, if you have established a right that, okay, the services are performed, I have a right to receive this with no other contingency, no other restriction. There's not a restriction that, okay, if you finish this step, then only you have a right to do it. Like, I mean, we have prepared the tax return, but that doesn't mean anything. If we don't e-file it, we are not finishing our work. So we cannot go ahead and invoice that we have prepared the returns and we have a right to receive the payment against the invoice. No, it has to be also filed. Okay, so there is a condition attached with it. So if we have a claim of right, not any restriction, then even though later on, like even though the payment is not completely fixed, or say we are just giving a range, we don't know, actually number will be calculated later, which is okay, we can just take an estimate. Or maybe the taxpayer can come later and say, no, you guys have not provided the full service, we need a discount on that. That could be also done later. It could be altered later. So it doesn't mean that if we have to issue a discount later, or if you have to issue full 100% refund. Let's say we completely filed a wrong return, and the taxpayer is saying, okay, we have paid you, but then you need to give it all back because you just did some other work which was not called out for. So later on you need to reverse it, but that time the right has been there and all. If the payment is not received, then payment is not included in income. That is different, yeah. Okay, so this is again claim of right doctrine. That's important, that there has to be a right which needs to be established and without reasonable restriction, without direct conditions to attached with it. And it's okay even if later on you are changing the amount or issuing discounts and all. So the next point is compensation for services. Any service which is provided, it's considered to be any compensation for personal services is gross income. Now, what they're trying to say here is not necessarily it's always paid in cash. Right? Sometimes they may say, okay, if you do this work of mine, I'll give you so many stocks. So we need to see what is the fair market value of those stocks and what is the valuation, reasonable or fair valuation, and then take that as an income. Or maybe they'll say that we'll provide you with this club membership, or we'll provide you some discounts on something that you're trying to buy. So that's also a kind of income, right? Because if you had to pay, say, like $50,000, but now your company is giving, your employer is giving some discount, and you're paying only, like, say, $40,000, that $10,000 needs to be added as income. So what they're trying to say here is that not necessarily everything would be paid in cash. There could be other arrangements, paid in kind, paid in different ways, or paid in form of property. And we need to see what is the value of that property, and that needs to be put up as taxable income. Okay. And they've just given an example that if they're like the tips are given in the restaurant business, if the tips are given, then how do you allocate tips to the food and drink sales, and also usually they say just take 8%. That's again not necessarily the customers are paying 8%. Some may be paying 10%, 15%. Some may just pay zero, or some may even put like only 2%, 3% as tip. But for the sake of simplicity, IRS has given 8%. Okay. Again, virtual currency, this is very, very common now. The cryptos, the Bitcoin and Ethereum, and like all those, there are a lot of other different currencies which people are investing in, they're buying and selling and all. So again, they're treated as property for US federal purpose, and we need to see the simple capital gains rule will apply to them. Okay, and if the payment is being made, if the employer says, well, I'll give you Bitcoin for your service, we'll not give dollars, we'll give Bitcoin and all. Again, we'll have to see what date were issued, what was the prices on that day. It's like just getting paid as stocks. So which are traded on stock exchange. So we can always go and check what was the price and all, and that needs to be reported on Form W2, subject to federal withholding and payroll taxes and all. So now how will we get the payroll tax and withholding and all? That's something the employee has to pay as cash. Because employee is getting, say, Bitcoin, but the taxes still need to be paid in USD only. They cannot pay taxes in Bitcoins. Huh? So now they'll have to make some cash arrangements and pay that off. Any taxpayer who receives virtual currency. So we will also see a lot of our clients, they are trading in this virtual currency. There is a specific question which was asked last year that do you have any sale or purchase in the cryptocurrency market? Even purchases, not just the sales, because purchases will not trigger any income, right? If the one is just buying and keeping it, doesn't mean that there is any taxable income. Only usually the sale will result into income or loss. But IRS is gathering all that information. They're asking us to mark whether you're trading in, not even trading, whether you're purchasing or selling any cryptos. The moment you say yes, that will go into a different database, and they may, over the period of time, it's not like 1 year, like suddenly you say yes, and that year you get audit and all. Maybe over a period of 5, 7, 8, 10 years and all, they will start gathering that data. They will know which are the people who are regularly buying and selling. Then probably they'll start auditing their returns. Are they putting it properly or not? Because a lot of these companies like Coinbase and other crypto companies, they're not even issuing a proper 1099. So IRS doesn't have any way of knowing if they are, putting the correct gains or losses on their tax returns. Unless they start auditing and unless they say that, okay, give us your full year statement, and then they themselves are calculating. Now, obviously, it's getting better. Maybe this year, like slowly every year, they're putting in more controls and all. But Coinbase is such a huge company, publicly traded and all, and majority of the transactions are happening on Coinbase, and they don't even issue a 1099. So IRS has no information, like no way to know what is happening. That's why they're making all these rules that, okay, now they will just make the rules, they'll put it there in writing. And if you're not following it, if you're lucky enough, you don't get audited. But if you don't follow it, and if they start auditing, then the trouble is like huge. Penalties, fines and all, it's not even worth taking that risk. Okay, so we'll just finish up until prepaid income. Where is number 10? 9? Oh yeah, okay, this is 10. Okay. Prepaid income, generally prepaid income is taxable in the year received. Okay, yeah, this is an exception. I would say this is an exception to accrual basis also. Generally what they're saying, prepaid income is taxable in the year received. Whether the taxpayer is on cash and accrual. Usually, we will not take a prepaid as an income. Right, because the services have not yet been provided. So if one is paying for like full year of internet, we should not be taking that as an income generally, and we'll defer it. But here the rule is certain, slightly different, but again, for our software purpose and all, we are not taking, like, there is a lot of prepaid subscription income, full 1 year income and all, but we are always deferring it. But there will be some other exception, and they will give us some examples here. We'll go over that. But with prepaid, we need to be careful. Do we need to, especially with rent and all? People will pay full 1 year rent in advance. So, does that need to be taken as an income for landlord in the year when they have received the full 1 year rent in advance? Like, what IRS is saying, usually, generally, yes, you would have to take, even though you're following accrual method. But does that mean that the tenant can take all of that as an expense? Maybe no. So that doesn't sound fair, but that's what it is. Let's go over one of the examples, then we'll just close it here, and then we'll continue from... Okay, bartering services. I think that's how the age-old way of, like, that's how commerce evolved and all. But yes, that is all included in gross income. If like, if somebody is providing plumbing services and we say that, okay, we'll do your tax return for free. We have a client who is a plumber. Then that's called bartering service. And it needs to be included in the gross income for both the person at the fair market value. Again, what is fair market value and all? IRS will not go into that, okay, according to us, this is the fair market value and all. Again, the onus lies on us. We need to be able to prove to IRS that this is how we have derived fair market value. Assignment of income, that means giving income to somebody else. So it includes income attributable to a person, even though the income is received by other person. A lot of times they say that, okay, instead of giving me the income, I have to make payment to somebody else. So straight away, give it to the other person. It doesn't matter where it is going to, whose bank account it is going and all. What matters is who has provided the service and who has earned it. Earned it is like the person who has provided the service has earned it. That person should be paying taxes. Now, if that person is saying, well, I don't want this, you give it to so and so on my behalf, that's different. That's like a separate transaction that person is doing, which IRS doesn't care about. Okay, you can do whatever you want to. If you have earned the money, you can give it to anybody you want to. But we have to see who has the right to receive it, who is having control on that income, who has basically put in efforts to earn that income, and that person has to pay taxes on it. Okay. Effective assignment requires that transfer of property be complete and no control retained. If you say that, okay, like, we're talking about assignment of property, not assignment of income. If somebody says, well, I have this rental property, I'm going to give it to my friend, and all the income that comes, you only keep it and all. And then tomorrow you say, well, I need it back and all. Then that's not effective assignment. You should also leave the control over that thing. So that is called assignment. Otherwise, it's just temporarily you're giving somebody some income to someone. It's like gift. You cannot say that, okay, today I'm gifting it, now I want it back. Now I want it back after like a couple of years or whatever. Okay, let's just start reading this assignment of income. Who will do this? Hemant, 2.2.
Yes. Shift a life insurance and sale person directly his employer and to pay his commission to his daughters. The commission paid and shifted to daughter are gross income to shift.
Shift. Okay, not shift.
Yeah, shift. Sorry.
Yeah. So this person is the salesperson and he is the one who is earning commission. He can say that give it to my daughter or anybody, that's fine. It will still be income of the salesperson. Next. Right, because taxpayer makes a gift of interest earned, but the interest is earned by the taxpayer himself. He's just gifting the interest. He's not gifting the property. If he's gifted the securities to the daughter and then daughter is getting those income from the securities, then it becomes daughter's income. Yeah, so here he's just assigning the full asset to the daughter, saying that I'm not giving you income, I'm just giving you securities. Okay, whatever income comes or does not come or the prices go up and down and all, then that's all then that has become daughter's asset. So in that case, interest earned will be considered to be income of the daughter. Okay, we'll just do this thing. Divyansh, can you read this 2.1?
Okay, ma'am. Lucy is a calendar year accrual method taxpayer. She provides service on the December 21, year 1. She billed the customer in the first week of January, year 2nd, but did not receive the payment until the February, year 2nd. She must include the amount received for the service in the year 1 income. If she were on the cash basis, she would report the income in the year 2.
Yes. So what do you understand from here?
Ma'am, she was billing in the first year on December 21st.
Mhm. She
Lucy.
provided services. She provided
Yes.
services, and she's generating invoice in the month of January next year.
Okay. But until she not received the payment until February year 2, include the amount.
She must include the year 2 income in year 1.
See, simple thing. If she's on accrual basis, it doesn't matter when she's invoicing, when she's receiving. We have to go with when she's providing services. So it has to be considered as year 1 income. But if she does her accounting on cash basis, then it's fine. She would report it whenever she is receiving it. It could be year 2, year 3, year 4, doesn't matter. Right? If she were on cash basis, this is what they're saying. When to include that as an income. Okay? Okay, we'll just close it here. Any questions, anyone?